Welcome, everyone. I'm Bruce Ball. I'm VP of Tax at CPA Canada, and welcome to today's webinar with the Canada Revenue Agency. This is the first of a two-part webinar series that we're doing. The first part, today's session, will be a presentation from the CRA on a few key areas. We're going to do an update on the CEWS audit verification process that the CRA has just recently started. We're going to take a look at some outstanding CEWS matters, an update to some issues that we've passed on to the CRA. We'll take a look at some taxable benefit issues as well. And finally, we're going to do an update on some outstanding technical issues that fall into other different areas. And again, these are issues where we'd pass them on to the CRA for some feedback. Now, I did say this is the first part of a two-part webinar. Once you've viewed today's webinar, we invite you to submit your questions on Slido. The link can be found on our COVID-19 tax updates page. It's the same page that has this webinar on it. The Slido link will be open until the end of the day on Wednesday, October 28th. So we'll give you a chance to post your questions and also vote up questions that have already been posted. The second webinar, which we'll be recording and posting to our website in early November, will be a session where CRA responds to these questions, and we'll be taking the top questions that come through the Slido system. We hope you find the webinar informative. We've a number of things that we've been talking to the CRA about, and I'm going to turn it over to Ted Galvin just for some opening comments. Ted's been the person that we've been working with primarily during the pandemic, and we've been in touch quite a bit in exchanging information and questions, and it's been a very, I think, productive process for us, but also I think it's been helpful to the CRA as well. So Ted, I'll turn it over to you.
Thank you, Bruce. My name is Ted Galvin. I'm the Assistant Commissioner of the Compliance Programs Branch at the CRA. And we have worked closely with CPA over the years, and even more intensely during the COVID situation, benefiting tremendously from the insights and input, trying to adjust both the design of our programs and as well communication. So that partnership is an important one. Happy to be here today. Just some high-level messages for me in terms of the agency's posture right now. The first point is to make that we understand that your clients, the Canadian businesses, are in a crisis, both the health crisis, economic crisis. We also understand that you're business people, so you yourselves are impacted as entrepreneurs, as employers with people to worry about. And then the human element, like all of us, you have children or grandparents, parents, relatives that you're worried about, and you yourselves are going through this situation. And so the agency trying to take that on board and take that into account while still pursuing the important work that we have. This pandemic has made the importance of government expenditure really front and center to Canada, and ideas like preserving a level playing field, dealing with new programs where a very small number of people have tried to take advantage, but some have legitimately been confused about very new programs. And you have to remember the Income Tax Act around over 100 years. The baby of our programs, GST, HST, almost 30 years old, and the wage subsidy program kind of coming up on 6 months. And so, the possibility for error is obviously much higher. And so we see our role as balancing those two drivers, that there is a reality and we need to adapt, we need to accommodate, but we still have a job to do. And so it's about finding new ways to do the same thing in this new reality for us. A quick word on our core programs, very much a focus on the risk. And so in the most highest risk space, dealing with very sophisticated multinationals with criminal investigations, some minor adaptations, but still kind of the same clients, the same focus, the same work. In the small and medium enterprise space, more significant change. And you'll hear a bit more about that later today. And I think that idea of materiality, the idea of giving auditors judgment around time and an open conversation with CPA members around, would extra time make the situation better? Not unlimited time, but being reasonable about those things and using professional judgment. We have given new direction to our audit teams around scope. We try to lift the floor on materiality. We always try to practice materiality. And I think, some reasonable adjustment of that floor around what we really need to focus all of our time on together is appropriate. And we issued those instructions to the field. We're hoping as professionals, you're sitting across the table with a lot of fellow CPAs in our audit workforce, that professional judgment and reasonableness will prevail. I think my colleague Harry Gill will talk a bit more about the audits of the wage subsidy program, but I'll just say again, our very firm intention in this first instance is just to understand the risk landscape, understand the kind of mistakes or confusion or gray areas that could exist out there, and then take a pause and then develop the right strategy for them. And so not blindly tripling or doubling the number of audits, but this first series really is to understand what's taken place, and then coming back to groups like the CPA to have a dialogue about what's the best way to get at some of these things, recognizing that some could be tax policy questions, and some may be issues that aren't appropriate to resolve via audit. And so again, very happy for this opportunity to address you. Very much looking forward to your cooperation in making some of the ideas that I've talked about work on the front line, audit by audit, through dialogue with our auditors. So Bruce, I'll turn it back to you, and look forward to any questions that I may be able to address through the Q&A.
Okay, thank you, Ted. Next, we're going to do an update on the CEWS audit and verification work that the CRA is currently undertaking. So I'm going to turn it over to Harry Gill to discuss this part of the webinar.
Okay, thank you very much, Bruce. So I'm Harry Gill, the Director General of the Small and Medium Enterprises Directorate here at the CRA. Just one of the directorates that are involved in the CEWS compliance work, whether pre-validation or post-audit. So today I'll give you an update on that work and also what claimants can expect in terms of the process and communication with them and things like that. So, as the government rolled out these relief programs, it was done very quickly, and the priority was to get the funds out to the people very, very fast, and the businesses very, very fast. So maybe not as much sort of validation and work up front as CRA would normally like to do. Massive programs ranging in the tens of billions of dollars just for the CEWS alone. We're up to over 1.3 million applications, over $41 billion paid out. So it's really important for the CRA to ensure the integrity of the system and to conduct some compliance work, of course, using a balanced approach. Our initial compliance efforts were to use upfront computerized reviews along with a system of manual prepayment reviews as a means to validate the CEWS claims before they were paid out. So, we established a set of coded rules that diverted some applications for manual review based on criteria and using our existing tax data. Over the past few months, we've spent a lot of time honing our compliance approach. We've refined the prepayment review process, and more recently, we've introduced post-payment audits. So when claims are filed, they're initially subject to an upfront validation process that occurs before the claim is paid out. And in those reviews, they're a little bit more limited than what a post-audit was going to be in most cases. We're looking to stop ineligible entities from making a claim, prevent fraudulent claims, flag certain claims for review before they're paid out. When a claim is selected for review before the payment is made, again, like I said, it's kind of a limited review and not as much in depth as the post, which I'll talk about in a minute. A lot of times the prepayment reviews are conducted without needing to contact the claimant or the authorized representative, as the file can often be resolved by just checking our systems, verifying some payroll information to make sure that things make sense. But if we're not able to validate it sort of in-house, calls will be made and are being made to the claimant or the rep on the file to resolve the issue. In most cases, we're finding that, or in a lot of cases, we can resolve the file by just an explanation being provided, but sometimes we need to ask for documentation. So up until recently, we were only reviewing them but we had always planned to have some sort of a post-audit program, which we have initiated recently. This is where we're getting in a bit more depth, of course, looking at eligibility of the employer, but also looking at the qualifying revenue, that the drop has been calculated correctly, and making sure that the employees that are eligible are actually eligible employees and not contractors and things like that, and that everything is basically compliant with the legislation. So we're easing into the post-payment audits as this type of audit is new, and we want to make sure that we're coordinated. Lots of areas in the agency involved in this, auditors from different branches and programs. So as part of our sort of moderate approach to starting post-payment audits, we've assigned a cross-section of cases to auditors and examiners for review. So those reviews are in process right now. These include audits of individuals, partnerships, charities, and corporations ranging in size from small businesses all the way up to large multinational entities. For the claimants that we've selected so far for audit as part of this phase 1, as we're calling it, they include audits of periods 1 to 6. And the auditors are reviewing all claims within that period for all payroll accounts associated with the business number, the BN9. The cases that we've selected for phase 1 are from all regions in Canada, and we've selected them in a variety of ways to get a good coverage and range of businesses. So, you know, to select the workload, we've automated risk assessment processes which leverage, you know, automated edits and algorithms to identify risk, supplemental review and risk assessment by specialized workload development officers, leads, internal and external, claimants that were identified for follow-up reviews as a result of the more limited reviews that we did at the prepayment stage if we thought there was, you know, some risk factors, but we still paid out the claim. And there also is a certain random element as well, because again, we want to do a little bit of a test to inform our phase 2 process. So the results of phase 1 will be used to validate and modify the existing risk assessment processes so that, you know, going forward, we're really focusing on the cases where there really is high risk of non-compliance and not so much burdening compliant claimants. Will there be, so this will be like a dedicated audit program for a period of time. With the expansion of the audit of the CEWS until next summer, this dedicated program will likely last a bit longer than we had initially envisioned. Going forward beyond summer of 2021, or like those claims that are filed in summer of 2021, getting into 2022 and 2023, I suspect that the dedicated program on CEWS audit will likely stop, and the CEWS will just become another factor to look at within our normal tax audit programs. Just another potential risk indicator, let's say, in our regular audits. A question we often get from stakeholders is, what can claimants expect during the CEWS audit process? More about the post-payment process. You know, the process will be probably very similar to what an existing income tax audit looks like. You know, we generally advise our auditors to try to contact the claimant or rep by phone to inform them that they've been selected for audit, to discuss the scope of the review and to ask about how the claims were calculated. During the call, you know, they'll discuss things like the accounting records of the claimant with the goal of identifying the books and records and supporting documentation that will be required. Based upon that initial conversation, the auditor may also advise that a computer audit specialist will be in touch to arrange for the retrieval of electronic records. You know, the books and records required will depend on the type of claimant under audit and the complexity of the CEWS claim. More complex corporate structures, you know, consolidated financial statements, numerous payroll accounts, etc., will add to complexity and will clearly add to the documentation requirements. The auditor will send a letter confirming the discussion, and will send a detailed listing of the documents that are required for the purposes of verifying the specifics of the claim. If the auditor is unable to reach the claimant or the rep by phone, a letter will be sent as the first point of contact, but that is not the preferred method. We fully expect the audit to be a two-way conversation, and we've reiterated the point to auditors for the CEWS audit work. Many of you have no doubt seen or heard about the discussions that were making the rounds in the media and on the internet about the letter that was sent to a business with an extremely onerous request for documentation. I'd just like to clarify that the letter that was sent was a template that was meant to be an exhaustive list of documentation that an auditor could send, not should send. The intention was not that the entire list would be sent to a business. You know, I think this was a symptom of growing pains of a new piece of legislation, a new program, one where we had to mobilize auditors from all over the country to help with this audit program and set up procedures with very little time. We appreciated receiving the feedback, and we've already addressed the issue and reinforced the guidance with our auditors to ensure they only request the documentation that's necessary to support the claims under audit. I think this type of situation really highlights the importance of communication during the audit process. If you receive a letter that you think is too exhaustive or otherwise have a concern with the audit process, then, you know, we really want you to contact the auditor or team leader and have that discussion. We understand that it's a difficult time for most businesses, and we want to be reasonable and mindful of the realities, as Ted talked about in his opening comments. Our intention is not to create undue burden, but we still have the responsibility to ensure compliance and the level playing field and integrity of the system. Another question we get is about the specific information that's generally going to be required in these CEWS audits. So, I would say as a starting point, the auditor is going to need a copy of the attestation form for each claim and copies of the documentation that was prepared by the claimant when they completed the form, such as the working papers that document the revenue drop calculations. The auditor will also need to access to some of the accounting records in order to verify the revenue reduction calculations, and will ask for records for the current year and likely the prior year. Sales journals, general ledger, adjusting entries, all the usual stuff. Depending on the method used to file the claim, the auditor may also request monthly bank statements. Detailed payroll journals, of course, will be needed in order to verify that claims have only been made for eligible employees and to verify both baseline and eligible remuneration calculations. After the review of the information has been completed, the auditor may request additional information. They may expand the period under audit to review additional claims where there's risks or issues of non-compliance that have been identified, to include claims by related parties as well. So it really is situation specific. If an auditor determines that the claim should be changed or disallowed, they'll issue a proposal letter and will explain the reasons for the change, again, in line with our normal audit policy. The claimant will have the opportunity to provide a response and submit additional documentation to support their position, as would be normal in any audit. A final letter detailing the CRA position will be issued. If applicable, a notice of determination and a notice of assessment will be issued, and the claimant will have the right to file a notice of objection if they don't agree with the results of the or the findings of the audit. The claimant would be required to repay amounts previously paid, as well as applicable interest. And of course, in cases of serious non-compliance, penalties may be applicable as well. There's a few more words on communication. Not only have we had to adapt our programs to incorporate these CEWS audits, but we've all had to adapt to our new virtual environment as well. So like many of you, our auditors are mainly working from their homes. They're leveraging technology for their own safety and for yours and your clients. They'll rely on technology like virtual meeting platforms instead of in-person visits, and use secure online portals for the transmission of documentation and correspondence. So really encouraging businesses, again, sign up for My Business, and for reps to sign up for Represent a Client to make things go a little bit smoother if you haven't already done that. And of course, other options such as email communication may be explored as a last resort. So we do sort of have a temporary permission to be able to use email, but it comes with a disclaimer that's discussed with the taxpayer and whatnot, but that is an option now. So on that note, I'll end my part. I look forward to hearing your questions through Slido and clarifying anything that you need follow up on the November 4th session. So back to you, Bruce.
Well, thanks, Harry. That was really useful. I hope that's provided some more sort of a better feel and clarity for people who were wondering about what the next steps would be. So I think that's really helpful. And again, I think you've highlighted how you're going to adjust your approach for the time. So I think that's great. So next on the agenda, we I guess throughout the pandemic, we've been forwarding on CEWS questions to CRA. And our main contact point's been Randy Hewlett, who will he's going to take a run through some of the latest ones. We started off at the beginning accumulating questions along with the Canadian Tax Foundation and trying to prioritize them. Now we're just kind of forwarding them on, I guess, as they come in. So I'm going to turn it over to Randy for the next section.
Thank you, Bruce. My name is Randy Hewlett. I'm the Director General of the Legislative Policy Directorate. I lead a cross-agency team who's been dealing with technical issues related to CEWS. Much of our work has been included on our frequently asked questions, which are on the canada.ca website. So as you're likely aware, the agency also continues to receive more and more questions and are asked to respond to questions on the CEWS. We issue some technical interpretations also where we are asked. Our main focus is providing as much information as possible to as many entities as possible through the frequently asked questions, stakeholder sessions like these, information provided through telephone services, or the CRA's participation in various professional associations conferences. While we've had a few requests for income tax rulings with respect to the CEWS, due to the large number of inquiries that the CRA is receiving as a result of Canada's COVID-19 economic response plan and the nature of the CEWS program, the CRA is unable to rule on eligibility for CEWS or any other issues related to CEWS. As Bruce mentioned, we have a few outstanding CEWS questions from CPA Canada that I would like to go through in this segment of the session. The first is the ability to amend a CEWS claim. In order to receive the CEWS, an eligible entity must file a CEWS application form for each qualifying period for which the eligible entity qualifies and pays remuneration to an eligible employee. Some elections are available which, in general terms, help eligible entities qualify for CEWS in special circumstances. For example, certain elections, such as the election to use a baseline remuneration period other than January the 1st, 2020 to March the 15th, 2020, in respect of an eligible employee, can be different for various qualifying periods. Other elections, such as the election to use the cash method or the accrual method, must apply for all qualifying periods. An eligible entity that is elected to use the alternative approach for determining qualifying revenue for periods 1 to 4 is able to use the general approach for period 5 and subsequent periods, and vice versa. An eligible entity is generally allowed to file an amended CEWS application form for a qualifying period, provided the amended application form is filed by the deadline, currently January 31st, 2021, provided under the Income Tax Act. Where an application form was previously filed but a given election was not made on the form that was filed, it can be made in an amended application form for the particular qualifying period. However, where an eligible entity made an election on an application form filed previously in respect of a qualifying period, the entity cannot revoke or otherwise amend such election by filing an amended application form. I would like to note that the CEWS legislation is continually being reviewed to ensure that it meets its intended purpose and responds to the needs of Canadians and Canadian businesses. As such, this position is subject to change, and I understand is currently being reviewed. As usual, we will be sure to update our FAQs for changes in position. So the second question we've been asked about is CEWS disclosure and an update on the general announcement and the clarification of amounts. So Bill C-14, the COVID-19 Emergency Response Act, number 2, amended the Income Tax Act to enact the CEWS program and to authorize the CRA to publish the name of any eligible employer that applies for the CEWS. We are finalizing the creation of a database called the CEWS Employer Search, which will provide Canadians with a user-friendly way of seeing which corporations have received the wage subsidy. The creation of this database will provide transparency to all Canadians on how their tax dollars are being spent to protect jobs, allow businesses to keep employees on the payroll, and to rehire workers who were previously laid off, while at the same time discouraging non-compliance. It should be noted that the amendments to the Income Tax Act through Bill C-14 do not permit the CRA to publish detailed application information regarding the number of employees of a particular business or the amount requested on a specific application. There are statistics available on our website which will outline the total number of applications received, the number of employees whose wages will be supported by CEWS, and the total dollar value of subsidies paid. Currently, the launch of the CEWS Employer Search has been delayed as the design requires careful consideration of factors like privacy, confidentiality, and transparency. We understand that the information it provides is valuable to Canadians, and we are confident that our approach to share it reflects our commitment to fairness and integrity. When the CEWS Employer Search is ready for public use, an announcement will be made. The third question concerns paragraph 125.7 for C and D elections for periods 5 to 9. Paragraph 125.74C of the Act is a rule that allows an eligible entity to use the qualifying revenue of a joint venture determined as if the joint venture were an eligible entity, when all of the interests of the eligible entity are owned by participants in the joint venture and all or substantially all of the qualifying revenue of the eligible entity is in respect of the joint venture. Very generally, paragraph 125.74D of the Act is an election available to an eligible entity where all or substantially all of the eligible entity's qualifying revenue is from one or more particular persons or partnerships with which it does not deal at arm's length. The eligible entity and the non-arm's length person or partnership must jointly elect to be able to use the qualifying revenue calculation provided in this provision. Paragraphs 125.74C and D of the Act relate to the computation of qualifying revenue that apply for the purposes of paragraph C of the definition qualifying entity in subsection 125.71, which determines if the eligible entity meets the required revenue deduction needed to qualify for the CEWS for period 1 to 4. Given that amendments to the CEWS restrict the application of paragraph C of the definition qualifying entity to the first 4 qualifying periods, these elections would not be available for the 5th and subsequent qualifying periods. We have referred this matter to the Department of Finance for their consideration. As such, the CRA is not considering granting administrative relief at this time. I would, however, encourage you to check out our frequently asked questions for the most up-to-date information. Since I have noted it earlier, the legislation and our positions continue to evolve. The next question we've been asked is with respect to the use of retailed months. For counting purposes, many businesses do not report their results using the calendar month, instead using a floating month end. We have received a number of requests from representatives regarding whether a different cutoff than the calendar month can be used when computing the qualifying revenue for a prior reference period and a current reference period of an eligible entity for purposes of calculating the revenue reduction for a qualifying period in order to claim the CEWS. Subsection 125.71 of the Act defines current reference period and prior reference period with reference to an actual calendar month. Any departure from this is not supported by legislation, and as such, the Canada Revenue Agency is not prepared to accept the use of an off-calendar month and reporting period when computing the qualifying revenue for a prior reference period and a current reference period. If an eligible entity's accounting cycle does not align with a calendar month cutoff, they will have to do a manual calculation to compute the qualifying revenue for the relevant reference period in respect of a qualifying period based on the actual calendar month cutoff. That concludes my segment. I thank you for your time and look forward to receiving your questions.
Thank you very much, Randy. That was really helpful. As we've mentioned, there will be a chance to put some more questions in on the CEWS as well through the Slido process that we talked about earlier. So next we're going to move on to non-subsidy issues. And as we were accumulating issues, they actually broke down into issues that related to employment and then sort of a wide variety of other issues. So we've sort of accumulated, I guess, some of the employment related issues. We were planning to address, if we could, the T2200 as well. CPA Canada and other organizations have been providing feedback to CRA on home office expenses in the T2200, and we've had discussions as well, and our understanding is that CRA is still considering the feedback that was received. But unfortunately, we're not able to pass on anything at this point. So we're not able to speak to the T2200 today, but be sure to watch the CPA Canada COVID-19 update page. We will post anything as an update that we can as things play out. So I'm going to turn it over to Kevin, and we're going to focus on taxable benefit issues.
Thanks, Bruce. Right, my name is Kevin McKenzie. I'm the Director General of Business Compliance, which means I'm responsible for, among other things, programs that ensure employers meet withholding, remitting, reporting obligations, of course, with respect to source deductions and taxable benefits. So today I'm going to say a few words about some administrative positions that the CRA will adopt for certain employer-provided taxable benefits during the COVID-19 pandemic period. Certainly, in light of the pandemic, the CRA recognizes that many employers and employees, for them, there's been changes in the way work is being conducted, and that employers may provide certain benefits, allowances, or reimbursements to ensure that their employees are not unduly subject to harm when performing their employment duties. So given these extraordinary circumstances, the CRA will adopt certain positions for employer-provided benefits. And I'm going to talk particularly about commuting and home office expenses that will provide some relief to employees and employers. So with respect to commuting costs, so the preamble here is that the longstanding position of the CRA is that travel between an employee's home and regular place of employment is generally personal travel, and expenses related to that travel are personal expenses. Similarly, an employee's parking costs at a regular place of employment are also considered personal expenses. And so if an employer paid for these, then the employee would generally incur a taxable benefit. But we acknowledge that employees are being required to commute to their regular place of employment in some cases to perform employment duties. During the pandemic period, it might be occurring additional commuting costs to minimize, let's say, risk of exposure. We also have employees who may be commuting to a regular place of employment to pick up say equipment that allows them to perform employment duties from home. So in situations where an employee continues working at their regular place of employment, the CRA will not consider an employee to receive a taxable benefit where their employer pays for, reimburses, or provides a reasonable allowance for additional commuting costs incurred by the employee. We would extend this position to situations, of course, where an employee is working from home because the regular place of employment is closed, and we would not consider the employee to receive a taxable benefit where the employer pays for, reimburses, or provides a reasonable allowance for commuting costs incurred by the employee to travel to the place, a regular place of employment, let's say to pick up computer equipment or perhaps other office equipment so that they can work from home. And both these positions would be extended to the use of employer-provided motor vehicles for this kind of travel. So maybe a word on parking as well. So similarly, when a regular place of employment is closed due to COVID-19, the CRA will not consider that an employer-provided parking spot at the place of employment available to an employee's use would result in the taxable benefit either. As always, in these kind of situations, there can be follow-up, and we would expect employers to maintain appropriate records to demonstrate that allowances provided are reasonable in relation to the commuting costs. And similarly, employees, if they're using employer-provided motor vehicles, need to keep some records of kilometers driven when commuting between their home and the regular place of employment. So also, we can go and talk a little bit about home office equipment, given that in the COVID-19 pandemic, many employees are having to work from home. And initially, of course, they may not have had necessary computer home office equipment to perform their duties. So in this context, the CRA will not consider an employee to receive a taxable benefit where the employer pays or reimburses up to $500 of computer or home office equipment to enable the employee to carry out their duties. Generally, we would expect there would be, if reimbursed, the employee would have receipts to provide to their employer. The home office equipment could include any item that the employee may need to enable them to carry out their employment duties, and common ones, of course, that we see being discussed include chairs, desks, monitors, and some computer equipment. If the employer pays or reimburses for more than $500 of computer home office equipment, it's the amount over $500 that must be included in the employee's income as a taxable benefit. So, for example, if an employer paid for a desk valued at $1,000 and the employee was keeping this, the ownership is not retained by the employer, then the taxable benefit of $500 will be reported, which is the $1,000 purchase price minus the $500 of relief. Related to working at home, we also know that some employers may choose to pay or reimburse for employees' internet or cell phone costs. So the CRA's existing policies maintain that the portion used for employment purposes would not result in a taxable benefit. And of course, there are some specific accommodations around cell phones that have been longstanding and we've published in the past number of years. This, as I said, like I've said, the CRA will adopt these positions. I share this with you, this information with you now. We will be publishing this information on the Canada.ca website, we trust, in the near future. And as always, you know, the agency continues to engage with stakeholders and receive feedback. Certainly employer provided benefits is one of those topics that is relatively active. The CRA will continue to listen to feedback and consider whether additional relief measures might be needed. As always, there is our usual information on employer provided benefits and allowances on the website. It's the the Guide T4130, the Employer's Guide to Taxable Benefits and Allowances, which contains information on these topics and, of course, many more. So that is what I would say about taxable benefits. I will maybe switch gears a little bit just to go back to a CEWS item. And this is around asset acquisition rules and the 805 error code. So where there's been a qualifying asset acquisition and an eligible entity and the seller jointly elect under paragraph 125.741E of the Act, the eligible entity is deemed to have met the conditions related to having an open payroll account with the CRA on March 15th, 2020, or using payroll service provider to make their payroll remittances on the eligible employer's behalf if the seller met either of those conditions. So what's happening is, given our validities that we have in place for upfront verification, the entity, the entity may not have the open payroll account on the record with us as of March the 15th, and so would receive the error message 805 when attempting to file its CEWS application, which says, according to our records, your account is not eligible for the Canada Emergency Wage Subsidy. And it directs them, if they have questions about eligibility, to contact our business inquiries line and the numbers provided. So in this case, because of the way upfront validations have been coded, where there's a qualifying asset acquisition, the entity should call the business inquiries line and explain to the CRA agent what has occurred and that they are electing under paragraph 125.741E. And the agent will be able to ask a few questions, verify the situation, and then based on the manual review, be able to add the entity to an exception list for us. And once we're complete, the agent will be able to advise the business, the entity, when it can apply for CEWS. So this, we believe, should help us deal with those situations where there has been a qualifying asset application to ensure that the continuing business does receive the CEWS support that it is seeking. I think that's it from me, Bruce, so I will pass it back to you.
Well, thank you, Kevin. That was really helpful. And we're going to move on now to Costa. And in the last section here, before some final comments, we're going to take a look at some of the other issues that didn't fall into one of the baskets that we've discussed so far. So Costa, can you take it away for the last segment?
Thank you, Bruce. I'm Costa Dimitrikopoulos, and I'm the Director General of the Income Tax Rulings Directorate. and our directorate is responsible for issuing rulings or technical interpretations regarding the Income Tax Act. Happy to be here, and I'll start with a question concerning the tax treatment of forgivable portion of the Canada Emergency Business Account, or CEBA. CPA members have been sending questions regularly on or if the forgivable part is taxed and when. So based on the information obtained from the Canada Emergency Business Account, or CEBA website, and based on the loan agreements with respect to CEBA loans with various financial institutions, we understand that the funds obtained from a CEBA loan can only be used to pay for eligible non-deferrable expenses which are listed on the CEBA website as wages and other employment expenses to independent arm's-length third parties, rent or lease payments for real estate and for capital equipment used for business purposes, payments incurred for insurance-related costs and for property taxes, payments incurred for business purposes for telephone and utilities in the form of gas, oil, electricity, water, and internet, payments for regularly scheduled debt service, payments incurred under agreements with independent contractors and fees required in order to maintain licenses, authorizations, or permissions necessary to conduct business by the borrower, and payments incurred for materials consumed to produce a product ordinarily offered for sale by the borrower. Since the CEBA loan contains a portion that is forgivable, that forgivable part is included in the income of the borrower in the taxation year in which the loan is received, by virtue of paragraph 12(1)(x) of the Income Tax Act. So for example, if a $40,000 loan is received in the 2020 taxation year of the borrower, and a $10,000 portion of the loan is forgivable, the amount of $10,000 is included in the income of the borrower for its 2020 taxation year, even if the loan will in fact be forgiven a few years down the road. A borrower can elect under subsection 12(2.2) not to include the forgivable amount of the loan in its income by reducing its outlay or expenses in respect of which the loan is received by the same amount. This election can be made with respect to an outlay or expenses incurred prior to the end of the following year. For example, let's say that the loan received in the 2020 taxation year is in respect of expenses incurred in the 2021 taxation year. The forgivable amount of the loan, that is $10,000 in the previous example, does not have to be included in the 2020 taxation year if an election is made to reduce the expenses of the 2021 taxation year. The election will have to be filed, by means of a signed letter to be attached to the tax return that the borrower is required to file for its 2021 taxation year. If the amount included in the income or not deducted as an outlay or expense because of the election I mentioned earlier, is subsequently repaid pursuant to a legal obligation to repay the amount, the borrower can obtain a deduction under paragraph 21HH for such repayment for the year in which the repayment is made. So another question that came up was with respect to loss carrybacks by an estate. The CPA is asking whether the CRA will extend the period of time required by subsections of the Income Tax Act for a graduated rate estate to dispose of its properties. CPA Canada has received feedback from its membership that delays in the probate process may delay the timing of the disposition of the properties of an estate. By way of background, subsection 164(6) of the Act allows a deceased taxpayer's legal representative to elect to treat certain capital losses and terminal losses realized in the taxpayer's estate in its first taxation year as losses of the deceased taxpayer for the taxpayer's last taxation year. Without the availability of this election, it would not be possible for the losses realized in a taxpayer's estate to be used to offset capital gains or income realized in the deceased taxpayer's final taxation year, since the deceased taxpayer and their estate are two separate taxpayers. The election effectively results in the carryback of the elected amount to the final return of the deceased. This election can be useful in addressing potential double taxation, which may arise, for example, where the deceased held corporate shares with accrued gains at death. However, for this provision to apply, the estate must be a graduated rate estate, and the legal representative must dispose of the capital property of the estate or all of the depreciable property of a prescribed class of the estate within the first taxation year of the estate. Subsection 164(6) of the Act does not provide the Minister of National Revenue with any discretion to extend this period. Furthermore, the Government of Canada has taken and continues to take action to limit the impact of the COVID-19 pandemic on Canadians. Among these measures, Bill C-20, entitled An Act Respecting Further COVID-19 Measures, which received Royal Assent on July 27, 2020, enacted the Time Limits and Other Periods Act COVID-19 or COVID-19 Time Limits Act. The COVID-19 Time Limits Act temporarily enables the minister responsible for the application of the federal act of parliament or regulation to suspend or extend certain time limits and to extend other periods in relation to specified acts and regulations for a maximum of 6 months by order. The specified acts of parliament and regulations are identified in the schedule to the COVID-19 Time Limits Act. Although certain provisions of the Act are mentioned therein, no reference is made in the schedule to subsection 164(6). As such, while we understand that delays in the probate process may delay the timing of the disposition of the properties of an estate, the CRA is unable to extend the time limit for the dispositions in subsection 164(6) of the Act beyond the first taxation year of the graduated rate estate. Finally, we'd like to note that the role of the CRA is to administer and enforce the Act as passed by Parliament. The concern raised in your email or in your question relates to tax policy, which is the responsibility of the Department of Finance. And that concludes my presentation. I look forward to receiving questions in November.
Well, thank you very much, Costa. So we've come to the end of the discussion today. So I wanted to thank all the speakers. We really do appreciate the CRA making time for us today and to give us an update on these things because it is important for everyone. And we hope that it's also given our members a perspective on just some of the issues in terms of the real life dealing with them as well. There are a lot of things going on, as you could see today. So I just wanted to remind everyone that you can go to Slido to post questions. The information was on the COVID-19 tax update page. Slido will be open until the end of the day on October 28th. And as mentioned, we're going to take the feedback from these questions and use them in a second session, a follow-up webinar where we're going to be doing a Q&A, and we'll be asking the CRA your questions, and we'll be posting this in early November. So please keep an eye on our website for updates on this. And again, thanks to all the CRA speakers, and we hope you found this useful. So long until we come back again in November.